Welcome back to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business. This video is all about long-term assets. We're going to go over some definitions about long-term assets, also known as capital assets. And then we're going to talk about the primary issue that you have to deal with when you're talking about long-term assets in accounting, which is how do you measure them, the value of them, after you've bought them? Then we're going to look at some tax implications and discuss the impairment and disposal of assets. So, what are long-term assets? Long-term assets are investments that contribute to earning income over multiple fiscal periods. Now, that's a textbook definition. They have to be investments that the company has made in something that will earn income. So if it's not something that's intended to earn income or will never earn income, that's not considered an asset. And it needs to be something that will generate income over multiple fiscal periods, because otherwise it's just an expense this year. There's two basic categories for long-term assets, physical and non-physical. Under physical assets, you have everything that's under the rubric of property, plant, and equipment. So property being land, plant being buildings, and equipment being everything else that the company owns that is a physical asset, like photocopiers and drill presses and trucks and so forth. Non-physical assets, the general category is intangible assets, not non-physical, but I'm just trying to be clear to people. So intangible assets are those things that you can't touch, but they're still assets that generate income for the company. So they might be something like a patent. And then there's a particular category of intangible assets that's usually considered separately called goodwill. And that arises only in particular circumstances that I'll describe later. So what are the elements of cost for property, plant, and equipment? There is a whole set of initial costs that need to be considered. So obviously the purchase price, after you've taken off any discounts or rebates that you might get for buying the asset. If it's something that you're building yourself, would be the cost of construction for buildings. And of course, any non-refundable taxes. If you buy something, oftentimes, almost always, there's sales tax on it. So that gets included in the acquisition cost. All other necessary costs are also included, and that's where we step out from the obvious sorts of costs. When you have to pay legal costs, such as registering title and so forth to a building, all those legal costs are necessary. Otherwise, you can't acquire the building. So they can be capitalized and included in the cost of the property, plant, and equipment. Site preparation, transportation, assembly. So if you're buying a very heavy piece of equipment and you have to reinforce the floor that it's going to be sitting on, or widen the door to get it in, the shipment costs to get it to its place of use, and all the costs necessary to assemble the thing and get it ready for use. Those are all necessary costs. And of course, you can't use a lot of equipment that's complicated without inspecting it and testing it. There may be legal requirements to inspect it before it can be put into use for certain kinds of equipment, but certainly you want to test it before you throw the switch on it. So all of those costs are necessary for you to put it into use. There's also things like design fees. If you had to pay an architect to design the building, or you had to pay an engineer to design the reinforcements for the floor for a heavy piece of equipment, those are all necessary costs. And then the curious thing that is often missed is that if you are financing the project through a loan, all the interest costs for this that are incurred during the construction period, during the setup period for the equipment, all of those can be capitalized. Now, after the asset is put into use, then those interest costs become an interest expense in the regular sense. But until the point the asset is put into use, all of the interest costs can be accumulated and added to the value of the PPE rather than putting them directly onto the income statement as an interest expense. And then obviously there's the problem of unnecessary costs. So if you were designing the widening of a door, and you brought the equipment in and you hadn't designed the door opening properly and you wrecked the building because the door was too narrow, that's an accident. That's unnecessary. You should have done your job properly. So that cost, the cost of repairing the damaged equipment and the damaged door, that cannot be included in the initial cost of the PPE. That has to be expensed right away. Now, there's also the issue of what happens subsequently. In other words, after you've put the asset into use. Down the road, you will need to do maintenance and repairs and so forth. And anything that is routine maintenance, regular repairs, that just needs to be expensed as a regular expense in the year in which it's incurred. But there's certain things that can be done to a piece of equipment that actually improve it in some way, going beyond simply repairing it. So if you think, for example, of a truck, If you have to replace a piece of the suspension or do an engine repair or an oil change, that's all just maintenance and repairs. If you have an accident and have to repair the fender or the bumper, that's just a repair. However, if you do something to the truck that actually improves it, for example, putting in a beefier suspension so that it can carry more, or putting in a high performance engine, or something that improves the fuel economy, all of these things actually make the vehicle better for you. And those things can be added to the book value of the equipment at the time in which you do them. So you might spend $100,000 for a truck this year, begin to amortize it for a few years, and then replace the engine with something that's either better or is going to last a lot longer than you'd initially intended. So that can be added to the value of the vehicle at that point, and then the amortization will continue from there. Basket purchases are a favorite of accounting textbook authors everywhere. It's basically the situation where you pay a lump sum for something and you actually acquire a whole bunch of assets. So, if you bought an existing building that had been in use, you might acquire the land, the building, and the equipment that's in it. You might even get some inventory that's still sitting in the building, all for one purchase price. What do you do about that? You have to allocate the price over all of the assets. And the way this is done requires some judgment, but you have to evaluate what the fair value of each of the pieces is. You get an appraisal on the land, an appraisal on the building. You could estimate the value of the equipment. You could even try to get a sense of what the value of the inventory would be. And you add all of that up, and that's going to be more or less than the price that you paid. And then you distribute the price over the relative percentage of each of those things. So if the land made up 50% of the total assessed fair value, then you would allocate 50% of the purchase price to the land. And whatever percentage the building was, you'd allocate that percentage of the price to the building. So each of those things, then the resulting calculations becomes the historical cost of each of those components. There's a possibility that managers might want to use this opportunity to produce favorable results. You know that land is not amortized, so the more that you allocate of the purchase price to the land, the lower your expenses will be in the future. And it depends on whether you're trying to maximize or minimize your income. Public companies tend to try to maximize their income. Private companies might want to minimize it in order to try to avoid paying taxes, because the higher your expenses, if they're tax deductible, the lower your taxable income. Also, different elements of building and equipment will have different amortization schedules, so that will affect the rate at which your purchase price flows out onto your income statement as an expense. And of course, if there's inventory in there, that's going to get expensed as cost of goods sold as you sell that inventory. So all of these things might be taken into account by managers. You hope that they will do it fairly, but they might take advantage of this opportunity to exercise some undue influence. And that's something to be concerned about if you're an auditor or if you're trying to analyze financial statements to see what's going on. Intangible assets, as I said before, they are the kinds of assets that have no physical properties. However, they still have to be identifiable, controllable, and they must produce future economic benefits. So if you can't identify them, then it's a problem. So for instance, you can't say one of our biggest assets as a company is our team spirit, our morale, because that's not particularly identifiable. You can't control the use of that morale and produce specific income and so forth. There's just no way to recognize that as a specific asset. There's also some things that you might have that are intangible assets in every sense of the word, except they won't necessarily produce future economic benefits. So they won't qualify as an asset that you could put on the balance sheet. So things like the intellectual capital of the organization and the value of your human resources, right? People are our most important asset. Neither of those can actually be recognized as an asset because the intellectual capital of a company is something that you cannot particularly control. The way that you have learned to work together, the way that you have learned to produce the most effective services that you deliver or products, all of those things are know-how that can't necessarily be controlled. And human resources, of course, can't be controlled because people can leave. They can go to another company. There's two categories of intangible assets, those that have indefinite life and those that have finite life. Anything with an indefinite life is not amortized. It's just subject to an impairment test. Anything with a finite life, such as a patent that might have a 7-year or 15-year or 20-year period associated with it, or copyright, the amount of time that you get to have that control over the asset will vary from country to country. But all you do with that is just do straight line amortization. And there's no residual value because when the patent is up or the copyright period is up, that's it. It's over. Here's some other examples you can look at for intangible assets. So if you purchase the use of a brand name, either by purchasing the company that owns it or purchasing the entire product and the rights to it, or just by licensing the brand name, that can be an intangible asset. You can have franchise fees. You can purchase quotas, for instance, in the dairy industry in Canada. You can obtain copyrights and trademarks and so forth. All of those things give you legal rights to an intangible asset. Intangible assets don't only arise from being purchased, they can be internally generated as well. And this creates some interesting and profound accounting issues. IFRS is quite picky about the distinction between research costs, which have to be expensed, and development costs, which can be capitalized. In order to capitalize development costs as an intangible asset, you have to be able to demonstrate all of the following: the technical feasibility of completing the asset, your intention to complete the asset and use it or sell it, your ability to use it or sell it, how the asset will generate economic benefits for you in the future, which means you have to show that it will be useful or you have to show that there's a market for it, the availability of the necessary resources to complete the development of the asset, including technical and financial resources, and the ability to measure the cost of development reliably. This is all a fairly tall order, which is why many companies err on the side of expensing their R&D. Goodwill, as I said, is a very specific kind of intangible asset, and it only arises in one particular circumstance, and that's when one company purchases another. So whatever the purchase price was for the company, you allocate the purchase price to the fair value of all the assets and liabilities that you acquire. And if there's anything left over, then that becomes the goodwill. So you bought a company for $1 million and there was $500,000 worth of assets and $100,000 worth of liabilities for net assets of 400,000. That means you have $600,000 worth of goodwill that you need to account for. Oh, and by the way, there's no such thing as negative goodwill. So if the purchase price was less than the fair value of the net assets, then you would prorate the purchase price over all of the net assets and record those assets at the prorated value rather than at their actual fair value. This is a way to avoid the complication of negative goodwill or a credit or a liability related to goodwill. There's no such thing. We simply have either positive goodwill or no goodwill. And as I said, it only arises when one company purchases another. It has nothing to do with whether your customers love you. Goodwill is not amortized. It is subject to impairment tests only. So every once in a while, you have to look at the acquisition that you made of the other company and decide whether the goodwill still makes sense to record as an asset. And if the acquisition is not working out the way that you expected, you should write down or write off your goodwill. All right, let's look at the question of subsequent measurement. There are two basic ways in which IFRS wants you to deal with subsequent measurement. So this is, what is the value that should be shown on the balance sheet for an asset after you've bought it, so in subsequent years? The basic problem that IFRS is trying to deal with here is that at the time of purchase, you've got a particular asset value, which is, as we saw, the purchase price plus all the necessary installation costs. But in subsequent years, the asset may have worn out. It may have been used up if it was some sort of resource, such as a mine or a forest. It may be obsolete. You acquired something which has become technologically obsolete. So in all of those cases, it would have gone down in value. There may be situations where you acquired an asset and in subsequent years, it's gone up in value. It's worth more. So what do you do then? There are two ways to do this under IFRS. There is the cost model, where you spread out that initial asset value over time in some methodical way. And then there's the revaluation model, which is similar to the way we just talked about dealing with goodwill, where you reassess the value periodically. With the revaluation model, it's not necessary to recalculate the value every year. You can, for instance, reassess it every 3 years or every 4 years. And then in between, you would simply amortize in the way that you normally would under the cost model. The key distinction here is that the revaluation model is going to produce relevant values for people who are reading the financial statement and are wondering what an asset is really worth compared to the cost model. Another thing you have to keep in mind is that you don't get to pick and choose which assets you revalue. If you own a bunch of buildings, for instance, you can't only revalue the ones that went up in value. You have to apply the revaluation model to the entire asset class. So all of your trucks, if you're using a revaluation model for trucks, you have to do all of them. You can't just pick and choose. If you're doing it for photocopiers or intangible assets of some sort or buildings, they have to all be done on a class by class basis. So you could, for instance, use it only for buildings and then just use the cost model for all of your equipment. So those are all the options that are available to you, and we'll discuss how to do that arithmetically on the next few slides. Let's talk about the cost model in general. As I said on the previous slide, the intention of the cost model is to spread the cost of the asset out over the estimated life of the asset. And the principle that's at play here is the matching principle. You're trying to match the expense of this asset to the periods in time in which the asset is generating revenue. What you need to know in order to do any kind of a cost model is you have to know the cost, of course, which we've talked about. That includes the purchase price and all the other necessary costs. You need to have an estimate of the useful life, which could be the number of years you expect it to last, or it could be something more specific, like the number of production cycles you expect a printing press or a photocopier to have. And then the final thing you need to have is an estimate of the residual value. What is it going to be worth to you at the end of the useful life that you've predicted? What are you going to be able to sell it for, either on the market or as scrap? So here's what the journal entries look like. Of course, the purchase itself is a debit to the asset and a credit to some combination of, say, cash or debt that you use to purchase the asset. And then what happens in subsequent years with the cost model is that each year you're going to have some sort of a debit to the amortization expense and a credit to accumulated amortization. Let's go over some amortization terminology for the cost model. There's 3 different names that are used. Tangible assets, typically we talk about them being depreciated. I think the general word is amortized, but when you say something is depreciated, typically you're referring to a tangible asset. And that means that when you talk about something being amortized, in a more specific sense, you're often talking about intangible assets. Natural resources like a gold mine or an oil field, they tend to talk about depletion rather than amortization because you have an estimated amount that's there and you use it up over time. There's a few other terms to keep in mind here. Net realizable value is what you can get for an asset. Residual value would be the net realizable value at the end of its useful life. So you expect it to have a certain value in the future when you're done with it. And then salvage value is just what happens if the thing is completely toast and you're just going to scrap it. It's also net realizable value, but it's referred to as salvage value to imply that there's nothing useful left in it. You're just going to scrap it. Which amortization policy should you choose? This requires a lot of judgment about how long you're going to use the asset and how you want to distribute the expenses over time. Keep in mind that whatever policy you use, it has nothing to do with your cash flows and has nothing to do with income taxes. We'll explain later. Also, that you have to use the same policy for everything in class. You can use different policies for different asset classes, building versus equipment, office equipment versus vehicles, but everything within that class has to use the same policy. The common choices are straight line, accelerated, and usage-based, and we'll go through what these are in some detail now. The straight line method is basically expensing the cost of the equipment over its useful life in a regular methodical way. As I said, you need to know the cost, you need to know the residual value, you need to know the expected lifespan of the equipment in order to determine amortization. And in this case, you are only amortizing the difference between the cost and what you're going to end up selling it for when you're done with it. And then you simply divide that difference by the useful life. The implication here is that this piece of equipment or whatever it is going to have equal earning power each year, but it's also used simply because it's so easy to do. There's no mess, no fuss. So some companies use this exclusively just because they can't be bothered with the other methods. There's a little wrinkle here about what happens when you acquire the equipment or the asset partway through the year. The half-year rule, which is used by the federal government in Canada for tax purposes, means that regardless of when in the year you acquire the asset, you do the amortization as if it was acquired halfway through the year. So you do the calculation of whatever the first year of amortization expense is and only take half. And what this means is that your decision on when to acquire the asset is not going to produce an undue influence on the amortization expense. For instance, if you were to take a full year of amortization in the first year that you acquired the asset, then come the 12th month of the year, you're getting towards the end of the fiscal year, if you acquire it and end up with an amortization expense equal to a full year's amortization, that's a pretty big hit on your income statement and not particularly useful. So the half-year rule allows us to avoid any concern about what the amortization expense is going to be and allow people to acquire the asset when they think it's the best time to acquire it and not worry about the accounting. A variation on this is the half-month rule, and all that means is that if the asset is acquired in the first half of the month, you take the full month of amortization, and if it's acquired in the second half of the month, you don't take any amortization for that month. So for instance, if it's acquired on May 26th, then you would not take any amortization for January, February, March, April, or May, and you would only take amortization for June and so on. So that would be 7 months of the 12 months worth of amortization for that year. The calculations are a lot simpler to do in practice than they are to describe verbally. This is a graph of what the amortization expense looks like. This is just a graph to show you what the amortizations would be. They're going to be identical all the way across over, let's say, 7 years in this case. So that's the expenses. If you were to try to graph the book value, it would basically be more or less a straight line. Of course, it's going to be stepped because you're stepping from one year to the next, but it would gradually decrease down to, now, see, I've got a little mistake here because I've amortized it down to zero, but actually you're only going to amortize it down to residual value. That's the conceptual view of it. The more clear view of it would be that the book value would come down in steps in some regular way, approximating a straight line until it gets to its residual value and then would stop. That's a very silly looking staircase, but that's the best I can do. I am no artist. The accelerated model is called the accelerated model because it amortizes the asset faster than the straight line method. It does this by taking the net book value and multiplying it by an amortization rate. The implication here is that because of the matching principle, you're trying to match more expense to the revenue that the asset generates early on the assumption that it is more productive early on, and later on it becomes less and less productive, so you're matching less and less expense to it. This might be the case if something goes obsolete very quickly and is no longer producing the kinds of products that you wish it to produce, or if it's something that becomes less and less efficient as time goes by because it's simply not as productive. Perhaps it undergoes more and more periods of repair as time goes by and becomes less and less productive over the years. In either case, you have to determine some sort of an amortization rate. It could be any percentage you want, but a lot of companies use what's called the double declining or double diminishing balance method. And what this means is the amortization rate would be 2 divided by the estimated useful life of the asset. So for instance, if it is expected to last for 5 years, 1/5 of that would be 20%, 2/5 of that would be 40%, use a 40% rate. So the first year you've got the cost times 40%, and then that gives you an amortization amount, which becomes the accumulated amortization, giving you a new net book value. The next year, you multiply the net book value by the same amortization rate, but of course, it's a smaller net book value, so you get a smaller amount and so forth. The half year and half month rules are used here as well, taking into account the idea that if you have a general policy of using a half year or half month rule, then you will always produce consistent amortization decisions with each of your assets, and you won't be giving the managers an opportunity to game the system in some way. With the accelerated method, you notice in the formula there's no consideration of the residual value. It's simply the net book value times the amortization rate. But you do stop once you amortize the asset down to the residual value. So here is what the pattern of amortization expenses looks like. So the first year you're going to get the largest amortization expense. The next year is going to be a little bit less and a little bit less, gradually tailing off towards zero. And you'd stop at some point when you reach the residual value. From the point of view of the asset value, it's going to start at some sort of a level and gradually come down in a way that's similar to this stopping when you get to the residual value. So in this case, it looks like the curve describing the book value is roughly similar to the curve describing the amortization expenses. A usage-based cost model is a little bit more complicated to do the calculations on, but it's still fairly straightforward conceptually. Basically, what you try and figure out is how many units is this piece of equipment going to produce over its lifetime. So you do the cost minus residual value calculation, which you've done in the previous methods, but you divide that over the number of units that you expect the thing to produce over its lifespan, and that gives you the unit expense. With that, then in every year, you can simply calculate what the expense should be based on how many units the equipment actually produced. So a photocopier might be rated at lasting 100,000 copies, or a drill press might be rated at 1,000,000 cycles. You would then calculate what the cost is minus its residual value and divide it by that number, 100,000 or 1,000,000. And then you measure, and this is where the extra expense comes in for you, the extra cost. You have to keep track of the number of units that it's producing, but oftentimes that's recorded for you by the equipment itself. And then you multiply the unit expense by the number of units that were actually churned out by the equipment. The implication here is that the earning power of the asset is something that varies with the amount that you use it, with the output. And that makes a lot of sense for certain kinds of equipment. So what does this look like in terms of a graph? It depends on the usage, of course, but here you're all over the map. In year one, you used the equipment a moderate amount. In year two, you got heavy use out of it. In year three, you didn't use it as much, and so forth. And that's going to change the amortization expense each year. And of course, that is entirely driven by the actual usage of the machine. If you're not going to be using one of the cost models, then your only other choice under IFRS is to use the revaluation model. And as it turns out, this is the model that IFRS would like everybody to be using, but companies don't use it because it can be fairly expensive to implement if there's no immediate liquid market that you can point to where people can just look up the price. For an investment in stocks or bonds or something, you can always look up the price immediately. But if it's a building or something like that, you have to pay an appraiser to come in, and that can get expensive. And so companies tend to use the cost model by and large. But the point is that in order to use the revaluation model, you have to be able to reliably measure the fair value, either through a liquid market or through an independent appraiser. So it's typically used for investment assets. As I said, sometimes it's used for production assets, but it depends on what the benefit is to the company. If you want to use this for buildings, for instance, you might get an appraiser in every few years, and then in between those years, do an amortization of some sort. And that would cut down on the number of appraisals that you need to get. But it would also produce more relevant asset values once in a while when you do those appraisals. So we'll go over all of this in more detail when we get to the financial assets section of the lectures. The important thing that you need to note is that the revaluation model could have the asset value going up or down. And if it goes up, that's a form of income. If it goes down, that's a form of expense, just like amortization. Now, with the incentives that are there for managers to try to produce inflated values for their assets and increase their net income artificially, there are a couple of ways in which the increase is parked for later appearance on the income statement. One of these would be if the value of the asset goes up above historical cost through the revaluation, then the difference would be stored in other comprehensive income rather than as income itself. And if it's not stored in other comprehensive income, it can be parked in very similar fashion under something called a revaluation surplus. Both of those would be in the equity section, and they would not be realized as income until you actually dispose of the asset. Having looked at what's allowed under IFRS, let's have a quick peek at some of the models for subsequent measurement of assets that are not allowed to be used in IFRS statements, but they're still useful for management purposes of one form or another. One of the non-IFRS models is replacement cost, and it's quite important for insurance purposes because if you want to get an asset insured, the insurance company needs to know what it's going to cost to replace it. It's not very relevant if the asset that you've got is completely unique and can't be replaced. But at any rate, if you are going to be calculating replacement cost, you need to look at all the costs necessary to replace it. Just as when you're capitalizing an asset, you have to include all the necessary costs, not just the purchase price. Value in use is a model that is extremely important for understanding what the asset is actually going to produce for you in the future. So it's essentially the present value of the future cash flows. Present value is the idea of discounting future cash flows to their present value. It's the opposite of taking an amount that you borrow and adding interest to it month by month by month. It is working from the future value and using a discount rate, which is similar to an interest rate, and working backwards in time to the present. But at any rate, the present value of all those future cash flows has to include not just the ones that it generates directly, but the cash flows that the asset allows you to avoid. So all of this is an indication of the value to this asset for you in its use in the current business situation. So this is really relevant to a decision where you're trying to think of whether you're going to purchase an asset, of course. And it's a fairly complicated financial calculation, but the most important part of it is not the discounting, but ensuring that you've included all of the relevant cash flows. Recoverable amount is a notion that's related to what happens if the asset is not the going concern. So this is the kind of valuation that is imposed on a company when it goes into receivership, for example. It has to be the greater of future cash flows or the fair value minus the selling cost. So it's like net realizable value. It's used in impairment tests. So when you're trying to determine whether an asset is still worth what you say it is on the balance sheet, you would look at the future cash flows that are relevant to it and also what the fair value of it is minus the selling cost at this moment in time. So it's useful when the company is being liquidated or when the assets of a company are being taken into account as potential collateral for a loan. Obviously, recoverable amount is important to the lender because the lender is not going to take over the business. It's simply going to take the asset and dispose of it. Let's look at the tax implications of your amortization decisions. This is an example of a tax form for businesses. It's taken from around the year 2000. I've chosen to use an older version of this. You'll notice that it's divided into a couple of different sections here. So there's this whole section here for adding and this whole section here for deducting. The add section in the current form has 19 lines instead of the half dozen that are there. And the deduction section becomes so lengthy that it's on a separate form entirely. So that's why I have decided to use an older copy of this form. So what have we got here? What we have is a calculation to determine your net income for income tax purposes. And this means that what you're starting with is the net income of the company off of your financial statements. And then you add back a whole bunch of things and then deduct a whole bunch of things to arrive at the net income for income tax purposes. And what are the things that are added back and deducted? The amortization of all of your assets. So amortization of tangible assets, natural resource assets, intangible assets, all of that gets added back. So regardless of what model you use for depreciating your assets, it's ignored. It's all added back to the net income that you calculated for yourself. And then a deduction is made, which is the capital cost allowance. So the capital cost allowance is the equivalent of depreciation expense on your tax form. So what does all this mean? It means that your amortization decisions for your net income calculation are completely irrelevant to your taxation. So what is capital cost allowance? Capital cost allowance is an amortization model that is specified by the CRA, and it's got very little to do with the kinds of things that you might take into account as a manager of a business. And it's got everything to do with the government's tax policy goals. It is set up with particular rates that will encourage or discourage certain kinds of investments. So when the government wants to incentivize companies to make investments in, say, new technology, it will give a higher capital cost allowance to those technologies as a way of encouraging the companies to make those investments instead of others. And the way this works, of course, is that with a higher capital cost allowance on certain assets, if you invest in those, you get a bigger deduction off of your tax bill. It doesn't mean that in the long run there's any change to your tax bill. It just means that this year you have a higher deduction and then next year you have a lower deduction. But it gives you the present value of that tax savings to play with. There's also an element to this calculation, which is to discourage tax avoidance activities. So this is the half-year rule. Regardless of when in the year you acquire the asset, you get a certain amount of the capital cost allowance in that year. And this avoids the possibility that companies will acquire assets on the last day of their fiscal year, hoping to get a big tax deduction for the entire year. So all of this is done to suit what the government wants to incentivize in the economy, what it wants companies to be doing or not to be doing. You will not get a big tax deduction for investing in an abacus, but you'll get a bigger deduction for investing in a modern computer, for instance. All right, so what happens when an asset is reaching the end of its useful life and you want to dispose of it? And also, what happens when an asset has turned out to be damaged in some way? Perhaps there was flooding or obsolescence or something that has happened that has made it worth less than you had anticipated. So, this is the subject of write downs and gains of losses. Let's look at those calculations and the journal entries that go with them. An impairment of an asset is a permanent write down. When the asset is permanently impaired, you are supposed to write it down from its carrying value, book value, and write it down to something that is a recoverable amount. The recoverable amount is going to be the greater of the fair value minus the selling costs or its value in use. So this is similar to the calculation that we're just looking at that is not allowed to be used under IFRS in normal circumstances, but is allowed to be used in situations where there has been a permanent impairment on the asset. When an asset is disposed of, whether it's sold or just decommissioned and scrapped, you have to remove the asset from your books. So you're getting rid of the historical cost and the accumulated amortization. And what you get for it, either by selling it or scrapping it, is going to be greater or less than the book value. It's almost impossible for you to predict when you purchase an asset and set up its amortization schedule that the eventual book value of it is going to be precisely equal to what you sell it for in the future. We're only going to deal with these situations where the sale price is greater or less than the book value. If you have a situation where the sale price is equal to the book value, that's a lucky coincidence. Here is an example where you've got a truck that costs $400,000. It's been amortized at $80,000 per year for 3 years. So the truck itself has a original cost of $400,000. The accumulated amortization is going to be 3 times 80,000 or 240, leaving us a book value of $160,000. So let's assume that this truck is sold for $200,000. If that's the case, you're going to have a gain on it because the $200,000 figure right there is greater than the book value of 160. What's the implication here? Let me just get rid of some of these highlights that I've just made here, and I'll show you. So the important thing when you're looking at this kind of a calculation is what it is that you know. So we know we sold it for $200,000. So there is definitely going to be a debit to cash of $200,000. And we know what the book value of the truck is, the historical cost and the accumulated amortization. So we've got the historical cost of the truck was $400,000. That's an asset account, so it's a debit. So we need to credit that in order to take it off the books. Same thing goes for the accumulated amortization of $240. That's a contra account to an asset, so it's a credit. We need to debit that in order to take it off the books. And where does that leave us? It leaves us out of balance on this transaction. We have 240 plus 200 is $440,000 worth of debits and only $400,000 worth of credits. So we need another $40,000 worth of credits. That means we've got a gain on the sale of the truck. That is the part of that transaction that goes onto the income statement. Everything else happens on the balance sheet. Let's look at the same situation, except that the truck is sold for only $150,000, which is less than the book value of $160,000. So what do we know? We know that we have $150,000 of cash coming in. That's a debit to cash. We know we have to wipe out the historical cost and the accumulated amortization on the truck, and all of those are on the balance sheet. And in order to make this balance, we got 400 in credits and we got 390,000 in debits. So we need another $10,000 worth of debits. That's the balancing part of the transaction right there. And that will be the amount that goes onto the income statement as a loss. So what does all of this mean? It means simply that when we bought the truck for $400,000 in the first place, we were going to amortize it over its useful life. And if we'd done a perfect job of amortizing it, we would have amortized it down to what we would sell it for. And of course, we can't predict that accurately. So the total cost of the truck was, in the first case, only $200,000. We bought it for $400,000. We sold it for $200,000. So we needed to spread that $200,000 out over the 3 years that we used it. And we amortized it a little too quickly. We amortized 240, so we need to back that off to the tune of $40,000. All that's happening here is we're making sure that the total amount of amortization that has gone out to the income statement is the difference between what we paid for it and what we sold it for. So if we'd done it perfectly, we would have had a total of $200,000 in amortization going out, but we didn't. We went a bit too far, so we back it off to the tune of $40,000. In the second case, we bought the truck for $400,000, sold it for $150,000. If we'd been really smart, we would have known that we needed to amortize this to the tune of $250,000 over 3 years. We didn't. We fell a little bit short, so we have to add another $10,000 of amortization expense onto the income statement. And the only difference here is that amortization expense is the routine amount that we have predicted that we're going to meter out onto the income statement every year. And the balancing entry that we do when we dispose of the truck is not considered amortization explicitly. It's considered either a gain or a loss. It's just a different name for the same thing, but it's characterized as a gain or a loss in order to identify that that was the balancing entry. If those gains and losses are significant, we might identify those on a separate line on the income statement. If they're not significant, if they're just a small amount in the overall scheme of things, then we might just include that in the amortization expense line on the income statement. All right, let's summarize what we've learned about long-term assets. We looked at the definition of long-term assets, also known as capital assets. They're investments that produce income over multiple years. If they don't produce income, they're not considered an asset. If they don't produce it over multiple years, then it's just an expense. We looked at the whole idea of subsequent measurement, right? So there's all these different cost models we looked at, the straight line, accelerated, and usage-based versions of that. All of these were methods of systematically spreading the cost of an investment over time, the time in which you are making productive use of the asset. We looked at the revaluation model, which is the alternative to the cost model. And the revaluation model is really dependent on having some sort of an independent measure of the value of the asset, either by being able to look at a liquid market for it or hiring an independent assessor to come in and give you a value. And then we touched on those non-IFRS models, replacement cost, value in use, recoverable amount. And what I meant by non-IFRS is that you can't use those as the basis of a cost model, even though they may be very valuable ways of looking at your asset value as a manager. And even though they may be used as the basis of the impairment test that you're going to be doing, but you simply can't use them in a systematic way in the way that a straight line, accelerated, or usage-based amortization is done. We looked at tax implications of your amortization models, and we learned that there is none. All of that gets undone in the tax calculation, and instead you use the capital cost allowance that's provided to you by the government for that particular class of assets. And I just want to point out that capital cost allowance is the phrase that's used in Canada. Other countries would have a different wording for that. But in most countries, it's a similar sort of a situation because the government wants to be able to use those capital cost allowances as a way to incentivize certain kinds of investments by the corporate sector. And finally, we looked at impairment and disposal of assets. So the idea of an impairment is that it's permanent. So you're going to have to write the asset down to what its recoverable amount is, and that would be potentially determined by its value in use. And keeping in mind under IFRS that you can write the asset back up if need be later on, but you only write it down if you believe the impairment to be permanent. If later on circumstances change and you write it back up, that's fine, but you can't just write it down and then write it back up to suit yourself. And we looked at gains and losses, which are just a way of reconciling the difference between the book value and what you actually sold the asset for, whether you sold it on an active market or scrapped it and got some kind of a residual amount for it. Either way, you're going to have a difference between that money coming in and the book value that has to be reconciled.
It's all about money.